Thank you, everybody. My name is Sargon. I'm a portfolio manager here at Wealth Management International. Very happy to be here with you today. Glad to see your smiling faces. Hope you enjoyed the wine. I hope the wine expert isn't here at the moment because I have a confession to make. It all tasted like beer to me. But it was good. So mistake number two, too little or too much stock or bond risk. And as the portfolio manager at Wealth Management, before I get involved with investing your money, you meet with a financial advisor like Tom. We have several that you'll see here today. And they go through a full plan with you. They take into consideration all of your assets, including, for example, money that you might have at a 401k plan, with your employer, or a stock option plan, or anything like that. Then I get the privilege of managing. So, well, too little or too much of stock or bond risk, we find among the people that come to see us that oftentimes they're either taking too much or too little risk. And I would say that is probably associated with a concern that most people have, and that is outliving their assets, which is a nice way of saying running out of money at retirement, right? And that is a major concern for people. So I think maybe that is a driving factor. So there's probably, I would say, two ways to run out of money in retirement. And one is not to take enough risk, for example, to overcome inflation or taxes, and the other is to take too much risk, right into a market decline. I have a friend of mine that I worked with when I was at one time an engineer, and he retired right at 2000, just before the NASDAQ went down, if you remember, 78% in less than 2 years. His retirement lasted less than 2 years, and I talked with him a few months ago, and as of now, he's still working. So really the key here is having the right mix of stocks and bonds, having the right mix of risk exposure, and taking that risk at the right time, because we find that everybody needs some risk exposure during their investment lifetime. So let's take a look at how this might look, taking too much risk or too little risk. So you invest your hard-earned savings in the market with a goal of growing your assets, hopefully in this direction, right, over time. So let's take a look at what it might look like if you're not taking enough risk. So we're chugging along, maybe in bonds, CDs, etc., and all the time we are safely losing buying power over time, and to find that at the end we have fallen short of the goal. And the other mistake would be, well, taking too much risk, like my friend I alluded to. And so we're very happy to invest in stocks when they're going up, and then, okay, so we've all been there, right? And it's the idea is being able to survive that kind of a roller coaster. And I think you're all familiar with combining different asset classes, real estate, stocks, bonds, and so forth, to get maybe a smoother ride. And I think really the key is not just how much, but when to combine, because that is the $64,000 question. It's not just the combination of stocks, bonds, and other asset classes, but how much risk you take and when. Here's another way to look at this. So let's say you buy a stock and it goes down 50%, gets cut in half. Let me rephrase. I know no one here has ever done that. So a friend of yours buys a stock and it goes down 50%, right? So how much would you need after a 50% drop just to break even? That would be 100% gain. So you have a $100 stock, goes down to 50, it needs to go from 50 to 100 or double, and that's just to break even. Not fun, that's for sure. So let's say we're invested in the stock market and we enter a market correction of, say, 20%. We would need a 25% gain just to break even. But if in the course of managing a portfolio, we're able to save or shave about 5% off of that 20% decline and have a 15% decline instead. In this case, we need 18% to break even. The difference, 25 to 18, that's 7% less gain that we need to break even. And that means a smoother ride for you, hopefully more peace of mind, and at the same time you have more assets to start with after the decline. So how do we do this? That's the other $64,000 question, right? So how do we do it here at Wealth Management? Whether you're in a conservatively allocated portfolio, moderate or aggressive or growth-oriented, in all of our portfolios, we do not maintain a static allocation of risk of stocks and bonds, but we manipulate that over time. We move it up and down depending on how we perceive risk in the market. Take, for example, a moderate portfolio here that is 60% invested in stocks or in the market, 40% out of the market. Well, over time, if we see that risk in the equity market is high, we can dial that back down, even as far as 45%. At times that we see that risk in the equity markets is lower, we could raise that, maybe even as high as 75%. So we fluctuate that. I think many of us have been in a position where we're allocated a certain way and the market changes and we're no longer happy with that allocation. And we want that to change. Well, we can do that without having to move around between different portfolios. So I guess you could say we manage risk. We focus on managing risk as opposed to focusing on managing return. And I would categorize maybe output risk maybe in two categories. And the first category being that you're aggressive, and when you're aggressive in the market, the risk you're taking is the market goes down. You have a market decline. And the other risk that you can take is you could be defensive and miss part of a rally when the market really rallies strong. At first glance, this seems like a no-win scenario. If I'm aggressive, I lose this way. If I'm defensive, it's that way. Well, really the key here is time. There are times that we want to be aggressive because we might feel that the further market decline, the probability is low. The market is a little washed out. The best gauge for me for that is when I put money in stocks and somebody says, "Are you nuts?" That's probably a good time to be aggressive because we generally feel less aggressive at just the wrong time, and we feel more conservative at just the wrong time. So when would we want to be defensive and risk missing out on a market rally? Well, when the market's been rallying for a long time and things are a little overpriced and the probability of a continued market rise is a little low, then in that case we might dial back.